Hello, everyone. Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. I wanted to get everyone basically just a general banking update here today with this episode. So I hope everyone is enjoying the holiday weekend. I hope everybody's taking in a whole lot of football and other sports and other hopefully fun activities and stuff as you're going along. But so I've got a whole stack here of all kinds of information. And I figured the best way to do this was just basically rapid fire. So I'm just going to read through all of this information, and then I'll kind of round it out at the end when we're done. So, all right. So inflation drifts up as fears of second wave of higher prices mount. So people still worrying a little bit about inflation. Barr, who is see here, who is Barr? Michael Barr, who is the vice chair for supervision at the Federal Reserve. So Michael Barr is signaling the end of what's called the BTFP. That's the Bank Term Funding Program. That was an emergency lending facility that was put out by the Fed in the spring of last year. So he's basically signaling that that's probably going to come to an end, even though there has been a ton of borrowing on that lately. And I'll have to kind of get into that because it's a whole different conversation. The SEC, they approved the Bitcoin basically the ETFs that started trading this week for anybody who hasn't seen that. JP Morgan Chase projected substantial net interest income declines off of a strong fourth quarter 2023. So JP Morgan Chase, they forecast meaningful sequential quarterly declines in net interest income in 2024, reflecting its asset sensitivity and market expectations for 6 interest rate cuts by the Federal Reserve this year. So they're looking for 6 interest rate cuts, which is, interesting. Banks can't count on loans for growth. So even as the biggest banks have grown and diversified, lending remains a core part of their business, and it looks like that will get tougher this year. So basically, banks can't look out for a whole lot of lending growth coming here in 2024. More banks bite the bullet and reposition their bond portfolios. I'll be talking more about this in another episode. So a lot of banks. So again, something I've talked about in a number of episodes now. Banks have an issue that started last year with what was called unrealized losses on their bond portfolios, investment portfolios, which was caused by the increase in interest rates. A lot of them now are sitting on negative values, but they are unrealized because the bank actually have to sell the securities in order to actually realize the loss. And a lot of times, if they hold those securities to maturity, they will actually make money. They won't actually lose money, but they have to hold them to maturity. But it gets very technical right now. In other words, if they had to sell them right now, this moment, they would absolutely lose money on a big chunk of them. So, but a lot of banks are basically biting the bullet and just saying, "Hey, we're just going to sell off some of the stuff we have. We're going to take the loss. We're going to basically bite the bullet, and then we're going to reposition our bond portfolios in a positive light." So. Bond rally looks set to reverse big Q3 2023, basically jump in banks' unrealized losses. So huge. So this is going back to December 11th. So this is about a month ago now. So a huge rally in bond values looks to set to deflate unrealized losses on bank balance sheets after another pounding in the third quarter. So basically, banks, the losses. Losses were deeper, but it also got better because the bond market really saw a rally there kind of in the third and fourth quarter, which really helped to get into positive territory for the year. Layoffs, branch closures reveal banking crisis may be far from over. So if you saw this week, Citibank announced that they were laying off 20,000 people, which I thought was that's not really the real number. The real number is basically 60,000 people because they just laid off 40,000 people in the last, I think it was like 3 or 4 months. So the reality is they've really decided they went from 240,000 employees down to 200,000 employees as of 12/31, and now they're going to lay off another 20,000. So I think that the headline was a little disingenuous with we're laying off 20,000. No, you've actually laid off 40,000 already, and you're laying off another 20,000. So you're laying off 60,000 employees. I mean, that's a massive massive reduction, and that's only, and the Citibank is just one example. I don't mean to pick on Citibank. It's just that they were just a bank that happened to be in the news this week. But many banks, many of the big banks across the, your top 20 banks across the U.S. have been laying off a lot of personnel in the last 6 months. Here's another article, U.S. banks trimming headcount as they embark on expense-saving plans. So after climbing steadily since the third quarter of 2021, U.S. banks count of full-time employees reached a 3-year peak in the first quarter. Salary and benefit expenses also surged that quarter. Seeking to reverse that trend, several U.S. banks have turned to layoffs this year, leading to a 1.5% decline in full-time employees and a 2.9% decline in salary and benefits expense for the industry between March 31st and September 30th of 2023. Recent commentary from banks at an industry conference suggests that the decline is likely to continue into the fourth quarter. It did. And I would say continue into the first 6 months of this year. Okay, credit turnaround expected in 2024, even as card delinquencies jump in the third quarter. So peak credit card losses might be coming into view after a jump in delinquencies in the third quarter. I personally wouldn't bet on that. Card delinquencies across U.S. banks spiked 41 basis points quarter over quarter to 3.09%. Yeah, I did an episode a couple months ago on bank debt, or not, sorry, bank debt, credit card debt and auto loan debt. So I suggest people check that out. It's something to keep an eye on. But no, I don't see credit card delinquency coming down anytime soon. I see it continuing to accelerate. U.S. banks' total assets shrink again in quarter three as industry remains wary of growth. So U.S. banks' total assets shrank for the second straight quarter as large banks work to comply with proposed heightened capital requirements. The industry reported total assets of $23 trillion, reaching its lowest point since the third quarter of 2021. Banks saw a 0.2% sequential decline in total assets in the third quarter, with much of that shrinkage coming from the largest banks. Many banks are opting to shrink their balance sheets as growth is currently not a priority for a variety of reasons, including the high cost of funding, the potential downturn of credit quality metrics, and looming changes to the way risk-weighted assets are computed. As some banks hunker down and shrink their balance sheet, others see an opportunity to grow. Here's an interesting article. So why prices are probably never going back down. So inflation has fallen to a 3.1% annual rate from its peak of 9.1%, but that means price increases are just slowing down, not that they're reversing. This is something I keep repeating again and again, but that means price increases are just slowing down, not that they're reversing. The policy of the Federal Reserve is to keep inflation at 2%, not to actually let average prices fall for a long time. And although average prices have risen 19% since February of 2020, some items have gone up much faster while others have fallen. And if you saw the episode that I did on inflation, and then one of the other episodes I just talked about, where I basically said that this is one of the dangers. I just did an episode on the Fed and what the Fed is doing that you might want to take a look at. But this is one of the dangers that we're looking at here. Is if the Fed decides to reduce rates without getting inflation back down to 2%, we risk, without having a recession, we risk having those prices permanently embedded in the economy. We risk permanently locking in that inflation. And that's exactly what this article is talking about why they think the prices are probably never going to come back down. So another article here that just says banks are not okay. Despite things going on, banks are still having ongoing issues. FDIC beefing up staff in anticipation of more problem banks. So the FDIC Corp is beefing up its examination staff following lessons learned from the bank failures in 2023 and an outlook of more problem banks in 2024. CD concentrations at U.S. banks rise above pre-pandemic levels. The U.S. banking industry's exposure to certificates of deposits rose to pre-pandemic levels, even as the growth of the product slows. In aggregate, CD balances at U.S. banks jumped to $2.6 trillion as of September 20th, 2023, up 10% from the previous quarter. The balances were 24% and 14% during the first and second quarter of the year, respectively. So banks, CDs really jumping. Credit unions face stiffer competition for bank deals in 2024. We actually just saw our two announced. I actually did an episode. I think it was one of my first episodes. It was probably about 4 months ago, where I did basically an episode on credit unions buying banks. You might want to check that out. There were just 2 deals announced this week of credit unions purchasing banks, and one of them was like the largest credit union buying a deal bank I think ever, based on either asset size or value of the deal, whichever it was. But this is a trend that is still continuing. I think that it's an issue. I do not think credit unions should not be buying banks, and I think we should be asking some questions about how we look at credit unions. In other words, if a credit union is growing to $2, $3, $4, $5 billion in assets, and then it starts running around buying community banks, is that really a credit union anymore? I think that's a fair question. I think that's something that needs to be looked at. So what else we got here? Major U.S. card issuers see November delinquency approximate early pandemic levels. Like I said, we talked about credit cards going up. High funding costs will linger in 2024 as U.S. banks jockey for deposits. So U.S. bank core deposit pressures subsided in the third quarter of 2023, but the industry is unlikely to see much more relief in 2024, despite the Federal Reserve's planned rate hikes. So in other words, what did we just say? We had the other article here that said CDs had really climbed. Interest rates being up, that means that banks have to pay out more money in interest on their products like checking accounts, savings accounts, CDs, money markets, all those type of things. And even if the rates drop, they're not going to drop fast enough that it's going to dramatically decrease what banks are issuing in terms of what they call, again, the funding side of banking, where the interest that banks are paying out to their customers. It's not going to dramatically drop that inside, say, 12 months. It may start to drop it a little bit more toward the end of the year, but I think a funny thing is going to happen, and I can't wait to kind of dive into this in another episode. But I think a funny thing is going to happen where, this is the first time in a long time, in 15 years, that people have actually gotten a taste of getting a decent return on their money for not really having to take any risk. In other words, you take $10,000, you put it in a bank CD, you get 5% on it, and that's not a bad return for basically taking zero risk. I don't think that people are just going to let that go super easy. So it's, again, something to take an eye on. We'll have to see how that kind of plays out. So markets price in rate cuts from major central banks in 2024. So again, the market, I think the market is kind of gone overboard here. I mean, they just think that the Fed and every other central bank around the world is just going to start cutting rates like crazy. And that's just going to blow through the entire year. I don't know that I necessarily see that happening, but again, we'll see how it plays out. So CFPB, they just put out a report where they identified challenges faced by borrowers in resumption of student loan payments. So basically, what are some of the issues here that they have seen come out? Well, we've got long hold times and abandoned calls as people try to call in to get information. We've had significant delays in processing income-driven repayment plan applications. We've had inaccurate and untimely billing statements. So yeah, basically the rolling out of the repayment of a lot of these student loans has not been fun. It's been met with a lot of problems, a lot of confusion. People are just continue to having issues with it. And these are a lot of people that are just, they just want to make their payments, and yet they're just, running in with a whole bunch of problems with the servicers and the companies that just deal with all the student loans that are out there. What am I trying to think of? I'm trying to hit on for a second here. So one of the things I heard was that the student loan payments, that 40% of the payments were delinquent, kicking off with that first payment they had to make back in October. I need to delve into that a little bit more. I need to see if there's any real numbers out there right now on student loan delinquency. But it is something I'm trying to keep a close eye on and see kind of how that plays out. So let's see here. So what else we got here? So FDIC's procured an agency should review policies on major asset managers. So the FDIC director, Jonathan McKiernan, said regulators should investigate the impact of the big three asset managers, Vanguard, BlackRock, and State Street on the banking industry. Yes, 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 and yes, and yes, and yes again. I have come of the opinion in the last couple of years that Vanguard, BlackRock, and State Street have become way too big and need to be broken up. These companies yield an immense amount of power, and they have an immense amount of influence over many industries, not just banking, but a lot of just, I mean, maybe even every industry that's out there in the public markets. They can dictate just so much stuff about what a company is going to do, how a company is going to operate, just because of the power that they have by the amount of shares and percentage of shares that they own of various companies. And I think that while, again, it's like a double-edged sword, like some of that might be okay, some of that might be good, but some of it I think is not so good. And I think that at the very least, there needs to be that conversation now about, have these companies grown too big? Do they wield too much power? Who exactly do they answer to? If you don't want to do things that these companies want you to do, what, in other words, what makes them the judge, jury, and executioner of what should happen in the market with publicly traded companies and how they run their businesses? Like, what gives them the right necessarily to just dictate openly to companies like what they aren't going to do? And I think, I'm not saying like, oh, we should do this, we should do that, whatever. I'm just saying that is a very legitimate conversation that needs to be had. And we need to start that needs to be, looked at more in depth. Okay. If everybody saw the episode that I did on open banking, I really hope you did, because that's I'm sorry, not open banking, beneficial ownership information. That we'll get to open banking hopefully in a second here. But so beneficial ownership information, BOI. I hope everybody looked at that, because that was a very important episode. But the U.S. Treasury's FinCEN enforcement network has received over 100,000 filings disclosing true owners of U.S.-based companies, which will be stored in congressional mandated business ownership registry, according to prepared remarks by Treasury Secretary Janet Yellen, published January 8th. So they basically got 100,000 companies to sign up so far for this. Keep in mind, there are millions of small businesses around the country, so 100,000 is not really, that's not really a lot, but it just goes to show you that, yeah, I mean, some people are becoming aware of this. They are filling out this information, or whatever. I'm against this. I'm sorry. I don't like BOI. I don't like this whole program. I don't think that this is, again, you have to watch my episode to see all the issues around it, but again, just something to keep an eye on. Let's see what else we have here. First, U.S. spot Bitcoin exchange traded funds got launched. Inflation accelerated in December, dimming hopes for imminent Fed rate cuts. So inflation accelerated to 3.4%. Yearly increase in December, up from 3.1% in November. It was the first time inflation had accelerated in 3 months. The uptick was more than forecasters expected, calling into question market expectations that the Federal Reserve could start rolling back its anti-inflation rate hikes soon. So again, like I said, inflation does not go up or down in a straight line. It goes in fits and starts. It spikes, it comes down, it spikes again. And then we have here, investors look past dismal projections for fourth quarter earnings. SoFi wants to be a banking powerhouse. I really like SoFi. I like their business model. We'll talk more about that. Again, Fed eyes ending emergency liquidity facility despite recent uptick in usage. Banks battle earning pressures as liquidity remains king. Lending sluggish, deposits hold steady as U.S. banks start reporting earnings. Here we go. Now, open banking. Unclear liability in open banking proposal may disadvantage smaller institutions. Yes. Smaller banks versus larger fintechs. While larger banks are leading the development of API connectivity in their digital banking suites, smaller institutions commonly rely on third-party vendors, but they do not necessarily have the same bargaining power with the larger data aggregators. industry executives wrote in comment letters. Let's see here. Loan and deposit beta stabilize as rate cycle turns over. So there we have it. So a whole crazy ton of banking news in there. So what does all that mean in a nutshell, though? Well, basically it means that the banking still has some headwinds right now. You're not seeing a lot of loan growth right now, and banks may not necessarily be able to depend on loan growth. Again, a lot's going to depend on what happens with the Federal Reserve and whether or not they increase interest rates, how aggressively how they decrease interest rates, and how aggressively they decrease interest rates. But banks seem to be batting down the hatches. They're laying off a lot of people. They're looking to get some of that salary expense off. Their banks are also closing some branches. So they're looking to kind of shore up the balance sheet. They're looking to shore up some of the efficiencies or whatever within the business. And because they know that they're looking at it and going, you know what, we got higher funding costs. We're going to have to pay out more money on deposits. It's not going to be a great year for loans. We're not going to see a tremendous amount of growth in that sector. And we might even have some deteriorating credit as credit card delinquency goes up, student loan delinquency goes up, delinquency in commercial office space goes up. So again, a lot of things happening. We'll have to see what happens with like bank M&A and stuff like that. But a lot of stuff on the horizon, a lot of stuff going on, and I will continue to keep an eye on all this and keep everybody updated as they come up. I hope everybody checks out this weekend. I posted up a lot of episodes. I had an interview with Bob Newman from Chatham Financial. I had a commercial real estate update. I had another episode. Is the Fed going to cut rates? Banks dumping loans. An M&A update, and then this just general banking update. So again, a lot of stuff, a lot of information out there, a lot of things for people to take a look at. I hope people take some time this holiday weekend to enjoy a lot of this stuff. And then I will be back to talk with everybody again real soon. And but again, make sure to please like, subscribe, leave a comment below. Love getting people's comments from there. Make sure to check us out on YouTube and Rumble and all major podcast platforms. And like I said, have a great, wonderful holiday weekend. And I'll be back to everybody with some great new stuff next week. Thanks.